Hello and welcome to another episode of the Clark Smith podcast. Today, I'm delighted to be joined by Michael Robinson, CEO and founder of the Gable Group, Gable Insurance, Gable Mortgages. And our topic today is around tribe mentality and challenging the status quo. A little bit of explanation of what I mean by tribal mentality. I found a definition here that there's essentially three instincts that rule us all. It's the peer instinct, our drive to fit in. It's the hero instinct, our urge to contribute and gain status. And the ancestral instinct, our need for continuity and tradition. And this manifests itself both in life and in business in terms of bringing people together and people feel comfortable and secure and safe in, I suppose, traditional ways of doing things, whether it be in business or in life. Now, innovation happens when we smash those. So, um, Michael, I'm delighted that we have the chance to discuss this because you've got quite a an innovation that you're bringing to market and challenging that triangle of different elements is something that you faced firsthand. But before we get into that, give us a little bit of background of yourself, people who don't know you.
No, thank you very much, James, and I appreciate the time as well here, and it's great to be talking with you. I always talk about the sneakiness of South Africans. We come from a country where you have to be on your game, you have to innovate constantly because you're really working in a very thought environment and a very market of very small margins. So you can't traditionally lay your laurels and make sure things come through. Myself, I moved to the UK about 8 years ago with my family. My wife's English, so I had to be very kind to her as my sponsor. Yes, dear. And it was very, very much a long-term scenario for us based on two things. One, I've worked my whole career in financial services, insurance, and banking, where it was a good opportunity to expand in that and drive some of that South African innovation culture. But also, kind of personally, where did we want to be in the longer term, but also access to Europe. South Africa is 11 hours from the nearest location, so it always takes 11 hours to get anywhere. Being able to jump on the Eurostar for 2 hours to Paris is a great convenience for us now. So, yeah.
Oh, brilliant. And you'd built and sold your own business in South Africa before moving here, and then basically had to start again.
Yeah, it was an interesting challenge for me because being born and bred in South Africa, I had innate market knowledge. I set up an insurance MGA there, a managing general agent, where we looked at personal lines and commercial lines for SME businesses. Built it up to a headcount of about 45 people, and sold that before moving to the UK. It did feel a bit painful to get rid of your baby, as it were, that you invested so much into. I quite sillily did my MBA at the same time, which I do not recommend you do both at once. Either start the business or do your MBA. Don't do both at the same time. My wife very kindly stood by me, so I've clearly done something right there. But moving to the UK was quite a challenge. I think, in South Africa, being a colony, you've grown up with English TV, English radio, English personalities. You work in business quite closely there, but it's very different when you're on the ground. And I realized that in order to work for myself again, because I'm quite passionate about building and innovating, I'd need to really understand the market from an insider's perspective and not an outsider's perspective. And so made quite a conscious choice that I'd come to the UK for 4 or 5 years, get to know the market, get to know the opportunities before adventuring back on my own. And didn't realize at that stage where I'd be building the business today, because I always thought I'd do something back in insurance, not non-insurance and banking. But it did present quite a good opportunity as the time went on. But I first had to go through that learning curve. And as most opportunities land, I had to go through some pains myself to be kind of that access point of innovation to drive through.
It sounded like quite a intentional, maybe it wasn't so intentional, I suppose almost a professional MBA going back into the market, relearning how things worked and trying to see the different pieces and parts of the market.
Yeah, absolutely. I think There's a great joke I learned about the MBA. They said, "How do you know someone's got an MBA? It's because they tell you." But what was quite great for me on that experience was learning to unlearn. I think I'd spent most of my career trying to accumulate knowledge, accumulate expertise, and then the one thing that really, really stuck with me in my whole experience was the learning to unlearn and challenging what you knew. So today I do this quite often where someone will come to me with a fact and say, this is the fact that we've seen. And I'll say, well, where did you get it from? What's the source? How did you get to that point? And it can become a bit painful sometimes, really digging down, because I think people innately want you to trust that they've done the work and come through with it. And I'm not questioning because I don't think you're accurate. I'm questioning because I'm trying to see is the source that you've been given a real source, because we tend to trust the source as human beings rather than validate the source. And I guess weirdly enough, that ties into our topic today, which is the tribe mentality of, I was told it's this way, therefore I act that way. I didn't verify that that was initially the right way to act in the beginning. And so that really was kind of the big learning for me coming out of the MBA as I went through it.
And it kind of plays into what I see in the modern world as well. A lot of people want a clinical diagnosis and a quick fix, like a medication, as it were. They don't want to look at what's the root cause, what's the real problem, and they don't want to put the effort in behind it. Is that what you saw as you came into the insurance market in the UK? People said, well, it's done this way.
Absolutely. I think, speaking for insurance for a little bit, the UK is quite fortunate. It is a first world developed economy, fifth, sixth biggest economy in the world. You can rest on what I call legacy ways of working. Your insurance premiums, you can put them up, you can run paper systems. It's a bit archaic. The need or the drive for innovation and productivity is not pushed there from a commercial reason, because there is so much, I don't want to call it fat, but there is a lot of excess running around and a lot of surplus running around. And so it's far easier to do incremental innovation rather than systemic innovation and completely change the model. If I use an example in South Africa now, the banks have had to evolve to a place where, as an example, you can actually renew your passport in the bank. You can buy your electricity in the bank. They've become financial services platforms. They've become lifestyle platforms to really innovate and drive customers into the engagement model, into the ecosystem. One of the most successful companies in doing that is Discovery Group, who are now moved overseas in terms of their ecosystem. In the UK, they operate under the Vitality brand. But it really is that ecosystem. They bring you into that financial services ecosystem. They do your insurance, they do your health, they do your life, they do your banking, they do your mortgage. It's a one-stop shop for everything. And you have to do that in a really small economy and innovate really lean, digitally driven, because there just isn't a market to go for. Where in the UK, you've got 70 million people that are relatively well off compared to your African populations. And you need to innovate and drive is a bit less, because you can still rest on the old ways of doing things. So for me coming in, there was a massive opportunity to innovate across the board, particularly in financial services, and particularly insurance, where you're governed by people that are inherently risk averse. They work in an industry where change is a bad thing necessarily. They don't want to make changes because you may miss them. It's a data-driven industry. And now you're changing the way I look at data. You're changing that mentality of how I get things. You're going to get a lot of pushback. And insurance is the key in that. It protects so much of our lives, yet it does not want to innovate.
Yeah. And I mean, we'll come on to that sort of point about change and driving change in the industry as well. But do you think, first of all, coming from South Africa, different environment where different ways of working just became the norm, and you didn't have these big legacy, ancient kind of systems and platforms in place that helped you to see things in a different light and see a way forward of how things could be done, and having that, I suppose, that exposure to something different helped shape you saying, well, actually, it can be done. I've seen it.
No, it's great. There's two examples I use often. The first is in South Africa, we leapfrogged the fixed line telephones to the mobile phones. There was no fixed line infrastructure when mobile phones came in. So majority of people did not have a landline. And so they just went straight to mobile tech, and mobile adoption was then very, very high. The other thing as well, that because we then moved into this digital environment very quickly and you didn't have all the legacy to get rid of, people started getting their post and things via email far quicker. Now, there is also an issue where structurally the postal service wasn't very efficient in South Africa. So the joke I say to people is I got more post in my first 3 months of the UK than I did in the last 15 years in South Africa, which is true because you just don't get post anymore. So it's a very paperless society. It's a very digital society from that kind of leapfrogging perspective. And so it shows you what is possible from that perspective as well, because there is no, you're not going to go back and say, well, now that we're a developing nation, we're going to put phone lines in the ground, we're going to fix our postal service. You're kind of catching up to where the world is today. Weirdly, like a startup in a weird way, because you don't have to build on the legacy you have internally. You can start fresh almost in another way. And so seeing that innovation and what that can be done then says, well, why can't it be done elsewhere? What are the barriers? What are the challenges? What are the internal thinking and structures we need to overcome to be able to get to this, world 2.0 that is possible, because we've seen it in a different location.
And what did you see when you came over here and you started in, these legacy industries, these legacy businesses as well, that had always had this, tribe mentality essentially of we've always done it this way. Innovation is incremental, piece by piece, rather than we need to think about this differently and almost rebuild it from the ground up for the modern world.
Yeah, it's interesting because innovation tends to not come from the industry itself.
Mm.
You look at Uber as an example. You would assume that a taxi company would have come up with the Uber app as an innovative step, but it took an outsider to come in. And this in my mind, there's kind of two reasons that drive this. One, and I won't name names, but there was an insurance company I worked with, and their chief operating officer said to me, "I'm 5 years from retirement. I've just got to show incremental innovation. My board wants to see me reduce costs 3% year on year. Don't come and tell me you're going to take 20% out of my cost base in the next 3 years. I don't need that. I don't want to be on the hook for that. I don't want to do it. I just want to move through." And so you get this almost, we perform to what we're measured and no more, because that's all we need to do. And the board necessarily doesn't want to push harder because they don't want to make claims to shareholders, and shareholders don't want to push too hard because they're probably working on behalf of pension funds. And so you get this whole cyclical think of don't push too hard because we're not going to deliver, and then I'm going to be exposed. And it always comes back to me about the who's on the hook for something when it happens. One of the greatest tricks I used to do to convince insurers to change was give them take them off the hook. When we looked once at working with an insurance company which needed to modernize, they were running a 1980s. If you imagine the old green screens, AS400 systems, they were running £5 or £6 billion worth of insurance premium on those systems. So very functionally rich systems, but no API connections, no external data sources. You're very much looking at Excel sheets for data and systems. How do you force that innovation? And when I did find a willing CFO and COO and CTO that was looking to do it, the problem they had is they couldn't go back to the board and say, well, we want to use this tech stack that'll help us. And then the board will say, well, who made the recommendation? And they're going to say, well, it was me, because then they're on the hook for it. Well, how did you get to this recommendation? So we brought in a consulting firm, one of the big four, and got them to go in and say, in our opinion, this is a good business technology for you. And they then had the opinion paper, and they took that opinion paper to the board and said, in the big four firm's opinion, this is a good thing to go, which gave them the cover they needed to break that mentality internally and to take the bold step, which worked really, really well. The upside for the consulting firm, obviously, is once the tech stack comes in, they get to help do the implementation work and make some fees off of it. So, it's really about creating the environment for change, and environment for innovation based on people's own inherent restrictions and measures that they are measured on. And so creating that and looking at that business now, they've in insurance, we talk about a combined ratio, which is, how much did I earn versus how much did I spend? And generally you want to be under 100% as an insurer. They were sitting at 122% as a combined ratio, i.e. they were losing 122 pounds for every 100 pounds they made. And now they're sitting at about 90% combined ratio. So it makes a huge difference for them in terms of taking this investment and doing it by creating the right environment to show that the world can work in a different way by breaking that mentality internally.
Yeah, and there's kind of two elements there that I take out of that. One, and I've experienced this myself, CEOs, boards, going out, hiring big, expensive consulting firms to validate what they already know. But like you say, to give that the air cover so that it's not it's not my idea, and it's here. Someone else has validated it. It's that third party, which is a little bit of tribalism as well, in terms of, well, they say it as well, so we can. It's not just me type
Yeah,
of
yeah.
mentality. And the second part of that is also, it sounded like in that particular instance there was a need for that to happen because it wasn't a sustainable business model with the ratios
Mm,
that they had. So there was almost that trigger point of, well, we need something to change. We need something to different. This is my idea. I now need to validate that through someone else. But
mm.
it needed the two elements there.
Yeah, it's they always talk about how accidents are always a comedy of errors, not a single event causes, a train or a plane issue. And at the same time, then you had a very soft insurance market. So the prices were coming down. And as the prices were coming down, obviously their loss ratios go up because their fixed costs weren't changing. Um, and you see this a lot in insurance companies where we move into a hard market. They suddenly go into profitability and they go, oh, I don't have to innovate now, I'm making profits. The board's happy with their numbers. And I'm going, well, this is the moment you should be innovating because then you're going to get the hockey stick returns. You should be investing the money now so that when you bring it out of the cost center, but they don't. So you're right. You need multiple factors to come together to be able to then push that lever to drive innovation.
No, absolutely. Brings us nicely on to your business, Gable Group, and
Mhm.
I suppose the ideas that you're trying to push at the moment, challenges in the market, the new way of thinking. So first of all, give me a bit of background as to, I suppose, the genesis of the idea and kind of where it
Mhm.
came from.
Yeah, no, absolutely. Thank you. So I think, look, from a South African perspective, homes are far more affordable in South Africa than they are in the UK. The joke I used to use with people is if you look at London versus Johannesburg, which is the big economic census equivalent, a two-bedroom flat in Johannesburg would cost me 1.5 million rand, and a two-bedroom flat in the middle of London would cost me 1.5 million pounds. The difference is the currencies are 25 to 1. So, it's a substantially different market. And so your loan to income ratios are very, very high in the UK. And what that means is people spend an inordinate amount of time trying to save for a deposit on a property that's growing at 4 or 5% a year, where your salary is growing at 1, 2, 3% a year. And so for me, it didn't make sense how in a market where the property prices are appreciating so high, that the lenders were so worried about 100% LTV loans or giving people enough money to get onto the property ladder because they were worried about negative equity and skin in the game and credit risk and all this lingo that started coming out when I started trying to do my own journey here of buying a property. Because in South Africa, you can get 100% LTV loans. And I just found it very hard that why couldn't I get? And some of the players here do offer 100% LTV, but they're not true in the sense, one of the big high street banks says, we'll give you 100%, but your mum and dad need to put 10% on deposit for 5 years. Well, that's a
Mm,
deferred deposit. Um,
mm.
we will give you 100%, but we want a second charge mortgage over your parents' place. Again, it's just alternative forms of security rather than a pure play 100%. And so I started thinking, well, what is the issue? And I went through this in my own. It took me 7 years to save for a deposit here, even though I'd sold the business and brought capital and everything. It still took me 7 years to get back on the property. That 7 years of rent that could have got into equity. My rent was 14% higher on average than what my mortgage would have been. It really just didn't make sense to me that as a generation, we are losing a decade of wealth to buy-to-let landlords and to pension funds and those that are owning these properties purely because you couldn't get a 5% deposit together. You can save as much as you want, but with rents going up as they do, you then have kids, you then have expenses, you rent low, you're trying to do all the right things, you end up buying a house at 40. And the average age of a first-time buyer in the UK now is almost 39 years of age. It takes an average of 11 years to save for a deposit. It's something in the region of 4.6 million private renters, 2.2 million fewer homeowners than you did 15 years ago. Um, and when you speak to these renters, they all wish to own a home, but 63% of them mention that the deposit is their biggest barrier to getting into home ownership. And looking at all the data, it just did not make sense to me as how we could have an environment where over the last 150 years with the property data, we're going up an average of 3.6%, I think it was, but we can't offer people 100% LTV loans. And yes, I know in certain areas you'll have dips in property prices, but if you look on a long enough time frame, 10, 20 years, that property price will go up.
Do you think
That
that's
just didn't make sense to me.
Do you think that's changed since the financial crisis? Obviously, that was the big event where I know it was very much driven by the US subprime loans and kind of packaging up and reselling of that to financial markets, which caused the housing collapse. Do you think that's almost, you know, again, that sort of ancient continuation and tradition of, well, this is what we're trying to avoid,
Mm.
that's become our kind of baseline risk profile.
No, absolutely. And when people talk about second charge mortgages or second-hand homes or buy-to-let properties, I absolutely agree with you. That is a commercial decision, and that requires someone to put some actual skin in the game because you're not emotionally invested into those decisions. When you talk about your primary residence, where you're going to raise your kids and have your family, that's an emotional decision for you that you've made on there. You don't wake up your average homeowner doesn't wake up every morning and go, oh, I logged into Zoopla and saw my house is in negative equity. I'm going to return the keys to Barclays now and move out. That's just not what happens. Secondly, the American economy is not a full recourse economy. The UK economy is a full recourse economy. If you return those keys and there's negative equity, you're going to be on the hook for it. So there are fundamentally structural differences. Now, the 2008 crisis and also 1991, I think was the other one, showed an issue in not high LTV lending in both cases or loan to value lending, but a high loan to income lending. And the financial crisis 2008 data found that in some cases you had loan to incomes of 7.5, 8.5, 9, 10 times your income. And a large portion of those mortgages are what were called self-certification mortgages. They'd say, do you make this money? Yes, there was no check. So that's reckless lending. If you engage in a practice of reckless lending, at some point those chickens will come home to roost, and they did. And the people that were being lent to did not have the financial means to cover the loans they were given. And then for me, then that said, well, this shows that high loan to value is not the problem. High loan to income is the problem. So if I go to the market and say, here is a loan to income that is affordable to you, let's say 4.5 times, and I've stress tested you as a customer to say at least 10% of your net free cash flow after all obligations are free. And I put on a floating interest rate to check that that's even right. And I've looked at the property as well on a postcode level to say it's in an area that's gentrifying, or at least on the app, there's nothing negative. Why would that not be a prime customer and a prime property to do 100% loan on? Your income's low, your gearing is low, you're invested in this property. The financial crisis exposed these issues, and the regulator jumped on it and said, we need to limit. And weirdly enough, the regulator didn't limit loan to value after the 2008 crisis. They limited loan to income. They said your maximum loan to income you can do is 4.5 times, and you're allowed 15% of your sales each year to go over a 4.5x to cater it. And so even that showed that LTV wasn't a problem. Yet lenders and credit risk guys go, particularly in the Basel regulations, once you're at a high LTV, there's a higher capital charge because they see it as a higher risk. And so you have this contradicting evidence in the market where the certain funders and regulators say this is high risk, and the other ones say this is high risk. And so we dug into it. And I almost use the analogy of correlation versus causation. So the analogy I used once to the regulator was every human being that died in the history of mankind drank water, therefore water causes death. So, it's a correlation versus causation thing. Are you looking at the right thing? And I think the regulator looked at the right thing, and they found that high loan to income was an issue. Also, that was set in 2008. High loan to incomes have moved a lot since then. Banks have moved on a lot since then. I think LTI, where they are now, is too low. It should probably go up higher. We can debate what that number is. And also there's a second question that says, well, if I'm in a 10-year or 20-year fixed mortgage, do I even need a loan to income cap because I've got predictability of price? So at some point you can have those debates. But the banking markets came in and said, oh, high LTV equals high risk for negative capital. And because they were the ones putting capital into this market, they were the ones worried that if a loan went wrong, particularly if you think of America where there's a non-recourse economy, if that house sold for 80%, 70% of its value, they'd lose all of that. And they couldn't retrench it. And so you kind of see why they then started putting this thing to say, we need to look at capital charges on higher loan to values because that's the exposure then. And so you can see where this mentality starts coming in, where you had reckless lending, genuinely reckless lending, genuinely unsubstantiated lending causing issues at very high loan to income levels, which then hugely inflates the property market that's unsubstantiated. And when it goes wrong, the high LTV properties are the ones that are going to have negative equity. But it wasn't because they were at high LTV that they were the problem. It's because they were at high loan to income.
Yeah. So what was your solution?
So kind of a two-folder, really. The first was, well, let's look at the mortgage market. what we could call the three wins for our customers. So the first win is, how can I help generation rent become generation homeowner? What we looked at was, over an average 5-year period, pretty much every property in the UK went up in value. Um, at least 1% a year if you really want to be conservative on the HPI. So 2-year, 3-year fixed mortgages, not the right place to play in this game. So we look at a minimum 5-year fix. We also find that you can't do interest-only mortgages. You need to do capital and interest. So over a 5-year period through amortization, you're going to pay off at least 1% a year on your amortization. So after a 5-year period, pretty much all 100% LTV properties are going to be between 90, 95% LTV, which is more than sufficient equity for even high street lenders to now start offering these customers mortgages. So my question was, how do I help them for the first 5 years? How do I help them get onto the property ladder now so that they don't spend the next 5 years paying rent? They can start putting in equity, start building up an asset base for themselves, a home. The other thing you find with people is, once they buy a home in a street, they become really entrenched in that community. If you're not renting, I'm renting, don't really care. But once you own it, you're invested in that community. And that, for me, also drives that community spirit, making people feel more earthed to where they are. And I felt there'd be a nice social cause there about people investing in their communities if they felt part of their communities. So how do we help that as well from a social element? So there really was a big S on the ESG for us here around the social side of this business. How do we really help those that really should be able to afford a home, that can afford the rent, but just can't get a mortgage because of a deposit, which made no sense to me. The second was then, as the lender, I'm now going to be going against the capital markets. I'm going to be going against the regulator, where I'm going to be doing a pure play 100% LTV loan to show them that the risk is very, very low. And so the three things we then did for the lender to create the second win was to say, not only will we stress test these customers correctly from an affordability perspective, we'll make sure the properties are well built, we're in good areas, so we'll be very selective as we build out the model. But then also we'll create internal risk mechanisms, and which is where the company Gable Sure then comes in. Is Gable Sure looks after the loans as well to make sure that they that if in the worst case event something does go wrong, at least the lender and the capital markets are put back into the position they were previously by taking a risk, well, not a risk, but by taking a view on these high LTV mortgages. The third win, which is kind of the key for us, was, because I'm at 100% LTV, there's an opportunity for the capital markets to invest in these loans to generate a higher than usual yield. But by using the right credit risk mitigants, by using the right insurance structures, we could ensure that they were not overexposed in terms of what we knew the Basel calculations would be. So through some very clever IP, through some very clever work that we've done internally, while our loans are 100% LTV on the tin, as in presented to the market, from a Basel perspective, from a capital risk weighting perspective, and from a market securitization perspective, our risk LTV is far lower. It considers low as 80% risk. So that means that if I am a BlackRock or somebody in this world, or a pension fund, I can get 80% LTV risk profile, as an example, for 100% yield. And we've created some really clever mechanisms to do that internally, to allow high LTV lending without taking on additional risk. So those are the three wins that we try to do in the market.
And that's through sort of essentially insurance.
Yeah, I mean, there's insurance as part of it. So we have the insurance structuring. Most mortgage lenders will be aware of something called a MIG, or a mortgage indemnity guarantee, which looks at portfolio insurance, which is a credit risk mitigant. The Basel regulations allow for credit risk mitigations through insurance. And so all we really did was challenge the status quo to say, looking at the rules of the regulations, looking at the black and white, this is how do we operate as a lender? Your big banks are not going to be able to be this innovative, because we touched on this in the beginning. I'm in a credit department at a big bank. I want to play into what I know. I'm not going to put my neck out and try and be really clever for something that's going to take me 16 different things to move when I'm not measured on it from a KPI perspective. If you look at the funders of these loans, they've got 10 deals on their desk that they understand. It's NatWest needs another 500 million for loans, whatever it is. That's an easy deal for me to understand. Now I've got this new lender who's getting clever with 100% LTV. I've got my own KPIs to meet. I'm not going to go invest time and money in that and go after it. And so it's this tribe mentality that we had to break. And so what we did was look at the regulation in granular detail, saying, how do I make it easy for the lender, for the broker, for the customer, for the funder of the loans to get behind this product without putting their neck out or breaking that mentality? And what we found is that the only way to do that is to build the lender yourself and kind of prove out the concept. And so we ended up building out this whole thing and going through for it from there.
Interesting.
So it's a combination of a comedy of changes we need to bring this whole thing to life. Yeah.
So I mean, you're talking about a conversation with one of the lenders that their idea was, well, why don't you just put the money on our accounts and if anything goes wrong, we'll just take it out.
Yeah, no, that was brilliant. So we met with one of the lenders in the early days before we started our own lender and said, we want to be able to help you issue high LTV loans, and we've got some clever things that can help you do that. And they said to us, well, why don't you just be the guarantor? We'll open a bank account here. You can stick some money in there, and if this loan goes bad, we'll just take it out. And I went, well, no, that's just a standard fit into your model that you already have, where I have a fund on deposit or a cash on deposit. And then I kind of sat there with my partner and said, this just shows that mentality. Because to come back for this guy to now go back to his board or to his credit team and say, what we're going to do is do something different. We're going to work with these guys and we're going to do this, but we're going to have to create a whole new structure that the market's never seen before in order to help first-time buyers and prime residential buyers get on the property ladder. I could just imagine what he thought around having that conversation, like the credit committees, the papers, the mentality he'd get internally going, don't do that. We can't do that. This is high LTV. It's insane. And so for us, it got to the point where we realized there was no, you have to take the Uber model. You can't go to a New York taxi station and say, here's an app that you can download so your customers can find you. You have to go completely outside of the market and say, we're going to show you how to do this. You will then eventually adopt and follow. But by that time, we've gotten a very different scale situation. And weirdly enough, some of the lenders, some of the smaller building societies are now looking at how can they partner with Gable to offer the same thing to their market customers as well.
Well, it's often the smaller players that are trying to gain market share that have that more open approach to innovation and how can we do things differently? We can't just repeat what the big boys that the incumbents already have. We've got to have a slightly different perspective and have a different risk appetite and risk profile to that. But then at the same time, I know we talked about this as well. You've still got to function within the traditional system, because obviously this from a direct to consumer perspective makes sense, but getting that I suppose inflow of leads, of opportunities is a challenge, and the traditional mentality for people even looking to buy is through brokers. And I mean, I didn't realize this myself, but because my wife's French, in France the model is you have your loan fixed for the lifetime of your mortgage, and you can remortgage at lower interest rates, but it doesn't sort of go up unless you're kind of mad in that respect. But here it's been almost a racket that it's been 2, 3, 5 years fixed, and that's kind of what you're offered. But and that's almost the I suppose the infrastructure that's already there that you've got to work within and find a way.
It's a challenging infrastructure. I mean, you're right. If you look at covered bonds and in Europe, the 30-year mortgage, in South Africa, the 30-year mortgage is quite standard. You don't have this 5-year fix, 2-year fix, 1-year fixed rate. The UK is very heavily intermediated. I think in the region of 85 to 90% of all mortgages are written via brokers. If I think about the typical broker market or in any industry, so when I started my career, I was an insurance broker. I would want to write insurance policies where I could keep earning commission, creates a steady income for myself. If I think about rental agents in the real estate industry, I don't want to sign a customer up to a 5-year rental agreement on a flat. I want to sign them up to a 1-year or 2-year and then renew that agreement and get commission again for it. It makes sense as a business model because it enhances your affordability. It enhances your predictability of money coming in when you've got customers every 2 years, every 3 years renewing. So it makes more sense for me if I was an intermediary to place you on a 2-year or 3-year fix because it would just make more sense. Now, this is obviously my opinion. You're good at IFAs out there. Will look at market cycles. They'll look at interest rates and yield curves and say it's probably better to fix you for 2 or 3 years because the interest rates are going up, or it's better to fix you for 1 year because the interest rates are coming down and you're better from another year yield. But at the end of the day, I think it's a very different market in how it's structured.
Mm.
And the norm is not 5 and 10 year fixed mortgages. It is 2 or 3 years, for some of the reasons I think would make more sense for it to keep revenue flowing into my business. And it's a difficult thing to challenge, particularly for us as a lender. We are an intermediated only lender. So we work very closely with intermediaries. We don't have a direct to consumer play. I think given the nature of what we do, we'd always want an intermediary involved to give that advice to customers to make sure that they're fully informed about what they're getting into. But there is that inherent contradiction. In other countries, South Africa is an example, they tried to move away from commission with the insurance brokers and the mortgage brokers to a fee basis, to try and ensure that you had better advice and better incentives. So it's a challenging model to break, particularly for us as a startup, because the customer pays a fee, we pay a procurement fee to the broker as well. And you want to incentivize the best outcomes for your customer, which is in case of a first-time buyer at 100% LTV, at least a 5-year fix on the mortgage to build up sufficient equity.
So talk to me a little bit more about essentially breaking that triangle between the regulator, the banks, and the brokers, because that's we talk about breaking tribe mentality or challenging the status quo, but it's still not an easy thing to do.
No, it's. I mean, look, I'll each one separately. The brokers, I think, that we've spoken to absolutely love this product, and it makes a lot of sense for their customers that they could now start bringing into it. So that's a really good win. The regulator
is that because there's a greater market that they can access, which it wouldn't necessarily generation rent that they couldn't access before? Is that what's
correct? Oh, no, I forget the exact number, but about 1.2 million mortgages are done on an annual basis in the UK. Majority of those are remortgages. So it's the banks fighting over the existing pie. What we've got here is an untapped market of about 4.6 million private renters that intermediaries can now bring into this market. And so for me, it's a very complementary business model where traditionally they would not be getting any revenue from these customers. They can now bring them into the pool, sell them a 5-year fixed mortgage, and in 5 years' time now add to that pool and add to it. So they're not fighting over the same 2-3 year fixes between everybody else. So it really does grow the whole market for everybody. A rising tide lifts all ships. So by breaking that mentality of I need a 5% deposit, I need to get into it, high LTV is high risk, you actually grow the market for everybody, which means everybody benefits from this kind of change in thinking. From the regulator's perspective, their core duty is to protect the customer, to ensure the customers are not put into harm. Mortgage prisoners are a reality. You can go into negative equity. And so for me, the solution was not to say we can't do this. It was to say, how do we do this? And where we do have gaps, i.e., maybe there is a property that goes into negative equity, how do we help that customer? What do we do to protect them? And that's where we spent a lot of our time, was for the 1 in 1,000 or the 1 in 10,000 event where you're going to have a negative event. How do we protect those customers so that the regulator's doing its job and we're doing what we need to do as a social purpose of this company? But we did get a lot of challenge from the regulator. One of the examples we used when we spoke with them was, we talked about if I was a high street lender and I assessed you, James, for a mortgage of £500,000, but I only did 80% LTV. However, we've all agreed that you can now afford this £400,000 loan. But if you took that £400,000 loan and bought a property for 400 grand, your affordability has not changed, but your LTV has gone from 80 to 100. Therefore, high LTV does not equal high risk. It's high loan to income that we need to look at. And so we really had to go through this with them to say that we're not going to be causing harm. And everything we've done as a business is about preventing harm. And so that risk for me was they saw high LTV as high risk, therefore high probability of harm. And we needed to show them that through what we were doing by being very selective on our customers, very selective on the properties we would lend against, how we physically value every property. We don't use automated models as much as I'd love to. We had to be very, very cautious that we were not preventing harm as we've been through that. The banks, ironically, was the hardest part. The funders of this, because they see this as, from a capital perspective, we work with a guy that does a lot of capital raising for us and has for 20 years for banks. And he says, you can come to them and tell them that they're going to make 1.5, 1.2, whatever on their money. That's great. What they're actually interested in is, are they going to get the 1 back? Everything else at that stage is bonus. So if they give you 100 million, are they going to get it back? Everything else is a bonus. And so at high LTV, they look at this as high risk. And therefore, we don't want to play in it. But it was really a lot of work to go around proving the mentality that this was different and that you could do it. And we see it with, we are quite fortunate that some banks have now spent the time with us to understand the model. European banks, ironically, to understand the model and to understand the risk, because they understand, the French market, they understand the Dutch market, they understand 100% LTV, they understand the risk profile of what we're trying to do, and now helping us now break that mentality in the UK market as we will. So we're almost innovating from the outside in, instead of the inside out.
Well, it's interesting. It goes back to sort of the way we described tribe mentality at the beginning, the ancient and continuity aspect of it. Those external banks, France, Netherlands, wherever, they have the history with LTVs of 100%, whereas here they don't. So there's a lot more resistance. So almost kind of, how do we work around this kind of challenge and bring that, show them first before they'll start to say, oh, our peers are doing it, that's how we can then adopt it. And I suppose that's the network effect that I suppose long term you hope to see.
Absolutely. I use the example of I think it was Facebook was the second, not the first. When MySpace came out and proved that people wanted to be on social networks, and Facebook came out and showed, well, this is how we do it better and how we innovated. And then everybody wanted an Instagram or a TikTok, and they're all just variations of some form of a social platform where people connect with each other. And I remember very much in the early days, people would go, but why would you put up your personal photos and your information on Facebook and share it out there? It's just a terrible idea. Now we just willingly give away data day in and day out. And that was for me the big thing was we need to come into the market and show them that this works, show them that the program, the structure, the support, the business works. Because once, the initial reaction when people see us go live was, 100% LTV, they're mad, it's going to fail. 2-3 years from now, when you've got 500,000 customers on your book and everyone, they're going to go, how are they doing that? Why are they not failing? High LTV is high risk. And then people will start questioning their own beliefs and their own internal models, and their own structures. And that for me will be the real win. Because at that point, the whole market now gets opportunities to get access to 100% LTV loans. And the whole of England and the UK and Scotland and Wales can now move onto the property ladder at 30 and not 40. And then we've achieved our social mission. But we couldn't do it by going through the ordinary structures and trying to break the internal risk structures in these banks. Because they haven't seen it before. They don't know how to look at it. They don't know which pigeonhole to put it into. I remember with one bank I spoke to you about a year ago, they said, oh, I remember something similar to this structure in 1991, and this is how it works. And I went, yeah, that's very wrong. It's not what it is. But they were trying to put it into a box that they understood, because then they could at least take that box and move it through the organization. But then that would be fitting into the tribe mentality, into the ingrained institutional thinking of that organization. Which doesn't work. A great example that always comes to mind for me is Steve Jobs when he built the Macintosh. Sorry, they went out and built it in a separate building in a separate area, completely away from where the establishment was. Because if they did it in the establishment, it never would have worked. No. So you have to kind of break out to force this thinking in a different way.
Yeah, I think it's the way the human brain works. It wants to pigeonhole things, put things into boxes, because then it's, I can group that together over here, I can group that together over here, and it makes it easier for me to understand rather than taking each as an individual idea. But it's, the challenge is being able to break through this and break down those barriers so that people can say, okay, see that on its merits as it is different. But I suppose, I studied philosophy, and one of the areas that I was particularly interested in was philosophy of language, and it was the idea that language in itself does not hold meaning. That meaning is implied by us on the words itself. That's how we can communicate with people from different nationalities, different languages, different dialects, etc. It's the context that we place on it rather than that. I suppose that's a little bit of what you've been doing, and saying, well, here's the language that you're used to. Let me try and change that context so that there's familiarity there. But we're going to change the context of how it works so that we can break some of these old ideas down.
Yeah, no, I used to say to my wife, because I've got 2 boys at home, and I used to say to her, the sounds he's making as a 1-year-old in his world is the language. He ascribes meaning to that. We don't understand the meaning is ascribed to it. But at the end of the day, every language we make is the sound that we ascribe meaning to. So I completely agree with you on that. And in these organizations, they've ascribed meaning and outcome and predefined outcomes to a set of things that is not necessarily true. Jeremy Clarkson is quite one that I think about. He says speed has never killed a human being. It's a sudden impact at the end that does it. So it's this case of you're applying that speed kills. Well, yes, I'm not trying to go against road safety here, but it's not the speed itself that's the killer. It's the sudden impact that generates the issue at the end. And so we as human beings, as you rightly say, try to fit things into boxes, say, well, 100% LTV is high risk because there's no equity, there's no skin in the game, I'm going to walk away. All these reasons I was told when I was a junior, all these reasons I was told when I came into this organization before I was indoctrinated and droned into it must be true. Therefore, I'm not going to challenge them. But even at the most senior levels of these organizations, when you're now accountable to the board or to shareholders or to pensions, you don't want to rock the boat. You just want to make sure you deliver on what's required of you, because to really challenge it now, you've got to stick your neck out. And if you stick your neck out, you're on the hook for it. And I don't have a Deloitte which can cover me in this case. I need to stick my neck out for it. And that people don't like to be comfortable. I forget who said it, but he said more people are afraid of success than they are of failure, because with success comes a change in responsibility. So you don't want to challenge those mythos.
Yeah, absolutely. I mean, we see it, the traditional ways of, I mean, from a hiring perspective, we saw a big boom in, I think it was in the 90s, where companies were like, well, we have to hire from these types of universities and these business schools, because that's, all you do is you create a factory, a line of people that all look and sound the same. Yes, they'll integrate more easily into that, but they'll all look and sound the same and do exactly the same thing because they've been indoctrinated in that way. Taking it out of that and looking at diversity and diversity of thought, diversity of perspectives helps to challenge and come off into better solutions, because you actually embrace different ideas, different contexts, different perspectives that help to challenge the traditional way of doing things.
Amazon, I think, is probably the best example of that. So there's quite famously a management ethos in Amazon, which is you cannot say no unless you write a thesis on why you're saying no. So the default position is now, in most organizations, the default position is always no. In Amazon, the default position is yes. Because if a manager wants to say no, they have to go and say no. Where it's much harder now to do that. So you have to say yes. And that's why you end up with a bookstore with a cloud service and all these other ancillary businesses that ordinarily wouldn't come from an online bookstore, because they create that ethos where to stop tribe mentality in a weird way, you have to be able to really go out of your way to say no. And yes, some of the ideas will break, but at least by not saying no, by letting it go through, by challenging the status quo as an indoctrination culture, you end up with something that's very different from a world-leading perspective.
Well, I think it's, I think we're indoctrinated as, I don't know, I've been guilty of this with my kids, almost justifying why something won't work, why you can't go and play with a sharp knife or so on, almost from day dot, we're saying to them no, and it almost becomes habitual in terms of that. But it's changing that mentality of saying yes, and how do we get through to this more experimentation phase and learn by doing, rather than, okay, well, we've always done this, we're just going to do this because it's safe and secure. But actually, how can we experiment and innovate and do things differently and challenge those structures?
No, I agree. That how do we change the world by telling people to stop trusting the patterns that they were told were good patterns, because they were told it was patterns. It wasn't done from experience. You learn far more from failure than you do from success. And those entrepreneurs that go and experiment and fail, the knowledge and the school fees that are earned in doing that inevitably leads to a huge systemic change in the world. I think you look at probably the good one that we're watching now that's going to reshape life as we know it is OpenAI and ChatGPT. 10 years ago, no one would have thought this is possible, but now it's being adopted in operations in business. White collar jobs are going to be on the hook for it. And someone said to me the other day, it's not AI that will take your job. It's a lawyer using AI or a doctor using AI that will take it, because it enhances the efficiency and breaks the status quo. It changes how you work in your capacity. And that's a fundamental shift for people that says you need to embrace a new way of working. My mother's a psychologist and has been for about 40 years. And her traditional way of seeing people was to do what she needed to do, take on the notes, do the refit. I've recently taught her how to use an AI in an anonymized way in her practice to create insights. And what it's done is give her effectively a virtual sounding board of, I don't know, 50 million trained psychologists to look at what she's seeing. And she's already seeing improvements in her patient outcomes by adopting this technology change. And that's breaking the tribe mentality. That's breaking the way of thinking, the way things were done before, using technology to do that. And I try to tie that back into everything I do in this business. We deliberately didn't hire mortgage professionals when we built the business for the first 2 years. We hired tech people, we hired insurance people, we hired other types. And we presented now when we did started hiring, the management, the compliance function, the SMF functions you need, from a regulatory cover, we presented them with this box that looked like nothing they'd ever seen before and said, don't tell me how to build the box. This is the box we've given you. Make it compliant. And it was very different for them to now have to come into that environment because it didn't look like anything they knew. But it works as you would expect in an Uber, for the taxi industry.
I suppose my experience with doing that as well is been you filter out quite quickly those that will, embrace those challenging ideas, and those that will say, "Oh, that's not the box I'm used to. I don't like that. I can't do it." But it's almost quite a good filtering perspective, because it's like, rather than being prescriptive and saying, "Well, you do this. This is where you're going to go. Here's the box. How do you fix it, or how do you make it work?"
My best example, and it's quite a universal one, is we don't do wet signatures on our contracts at Gable for the loans. And a lot of the solicitors we were talking to when we were trying to find the right solicitor partners went, "It's a legal requirement. You must have a wet signature." I said, there is no legal requirement for a wet signature. The land registry allows digital integrations. You don't have to fax through this thing. And you're right, it filtered out all the law firms that we should not be working with very, very quickly. And now we're a paperless organization. Saving the trees at least as well from the environmental perspective. But it showed that, where they went, "No, you need a wet signature." And I said, "Tell me why. Show me the legislation that says I need a wet signature on this mortgage deed." There isn't any. So, it was fascinating to go through that, breaking the mentality of things and how people used to work.
Yeah, absolutely. Michael, I could continue this conversation for a long time. It's a topic close to my heart, and I think a lot of people don't necessarily have that sort of open, experimental sort of mentality and challenging ideas that you have. So final thoughts. How do people get in touch with Gable? What sort of stage are you at? What's the future look like?
Yeah, no, thank you for that. So, I mean, it's always great to kind of poke the brain and really think about the esoterical, because I think that's when we create new ideas, getting out of our routine. So thank you for your time as well today to have this chat. From a Gable perspective, gablemortgages.com, we are live. We are intermediary-led only at the moment. We work with about 3,500 intermediaries in the UK at the moment. We are onboarding more as we go. We see a lot of our opportunity being in the new build space. So we work with a lot of the leading new build developers in the UK as well. Getting in touch, I think the old adage, as we said in the beginning, is you kind of need to follow the old tribe mentality. You need to speak to your broker, and they will get in touch with us, and we'll take it from there for any of those that are interested. But I'm really hopeful that as Gable moves, we will challenge the status quo. We will challenge how people think about lending. We will challenge the idea of the need for a deposit, and how we can securitize in alternative mechanisms, and hopefully move Britain from generation rent to generation homeowner. Gable, ironically, is an amalgamation of two words, with the generation able then becomes Gen Able and becomes Gable. So it's really about enabling and being enabled to enable people to do those, to be part of their community and to feel a sense of ownership in what they do.
Fantastic mission. Michael, thank you so much for joining me today. Absolute pleasure, and look forward to continuing our conversations.
Thank you, James. Appreciate it.